Morning, market chameleons, and soon to appear Dimitri Pargamonic, the King Chameleon. How you doing, Dimitri?
Good morning, Will. How are you?
Good to see you this morning, buddy. Let's start with the disclaimer. What do you think?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to give you guidance, help answer your questions.
Excellent.
That's the disclaimer.
What are we seeing in the pre-market this morning? Anything?
Yeah, let me share my screen. I guess, I'll go over, we'll take a look at what's going on in the pre-market hours. If you have any questions along the way, I know we introduced some new features. If you do have questions, let me know. I'll try to answer as many of those questions before the end of the show. If not, I'm going to move on and talk about, I think I'll talk about maybe IBM and Google, because that's one thing we were going to do last week. We didn't get a chance, just to address some questions that were popping up. So again, if there are no questions, I'll just head on to those. So with that, let's get started. This is the pre-market report. Stocks moving in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's take a look at the higher market cap stocks. I'm going to use this filter, looking for stocks, market cap 20 billion, market cap or higher. So we see here 9 made the percentage gainers list, 11 on the percentage decliners list. From that perspective, really a neutral, looks like neutral at the opening, not very bullish, not very bearish. Let me see if there's not anything sticking out at me right now. There's some trades there's some movers here, but not on very high volume. Let me look at the unfiltered list. We have some movers that are lower market cap stocks. So you get the BTX, SJ, this one up 73%, 41%. But just to save time, if there's no questions on the pre-market movers today, I'm just going to kind of move on and just to cover more of, IBM and Google.
Yep. I don't know if you want Mike from Naples, Florida, the mayor down there, is asking about Yum Brands. He's looking at a credit put spread, May 7. It can't be May 7, Mike, can it? Oh, no. May 7th expiration, 110-105 put credit spread. I don't know if
this?
YUM? YUM, yeah.
Okay. So this one, Yum Brands. Let's take a look at the options. So we got the May 7th over here.
Yeah.
Okay. So I'm on Yum Brands. I went to the options chain. I picked that expiration May 7th. So these are the options chain for the calls and puts. And what was the credit spread?
It was the 110-105 put spread, credit put spread.
Okay. So here's the 110 strike. So you're selling the 110 put. So I'm going to click on that, 245, 110 put, and the 105 you said, right?
Yeah.
And 105, and buying the 105 put right here. So I'm seeing that these markets right now are very wide, but let's take a look. So I clicked on these. So this is what it's setting up here. May 7th expiration, selling the 110 put, 245, buying May 7, 105 put, $1.75. I'm going to load that strategy. This is what it looks like at expiration. So we're getting a 70-cent credit, all right, because you're selling at 245, buying $1.75. So that's a 70 cents credit to you. Now pay attention to this. So you see here the market, 70 cents bid, 350 offered, midpoint 210. Very, very wide market. So it's a $5 put spread, right? So the most it could be worth is $5 at expiration. So if you're selling it at 70 cents, midpoint is 210. That's a really far distance. So always pay attention to that, because you want to get it as close to this midpoint as possible. think of it this way. The midpoint, that's options, right? They're marked to market. So options don't trade like stocks. So stock will trade on every tick. Every time there's a trade, the stock is moving. The options are derivatives. They're moving with the underlying stock. Even when there are no trades, those options are constantly getting repriced, and there's a new bid and offer updating as the stock is moving. So that quote, the bid and the offer, is kind of your fair value. So the midpoint of that, right, is considered the fair value of the quote. So whenever you do a trade, your broker, will mark your option mark to market, right? So wherever the quote is, the midpoint of that would be considered that market fair value. So you can imagine if you're selling it at 70 cents, midpoint is $2.10. It's like $1.40 away. It's a huge difference. So please, watch those spreads. That makes a big deal. Think about it percentage wise, how much that is. So now that we're looking at a very wide market, that it's not as liquid to get in and out. Bear that in mind while we go analyze the rest of it. All right. Any questions on that? Let me know, Will.
No, I remember Dan Passarelli, who we're going to have a show with on Sunday. He has a term for that does he call it the MIDI, or I forget what he refers to it as, but he is also
like middling it, or
middling it. Yeah.
Yeah. Yeah. And think of it this way. Like if this 70 cents, that's the price to get an immediate execution, right? You could always put a limit order in between, but to get an immediate execution, it's 70 cents. So think of it this way. If you sold it for 70 cents and you're like, oh, I made a mistake, I need to correct it and get out, and the next immediate execution is $3.50, that's a huge loss, right? That's a big fee to pay for an immediate execution. And you gotta really pay attention to that. That's why a lot of people out there just tell you to stick with the more if you understand this and you're okay with holding it till expiration, and if you could get a good execution, it's fine. But I have to just kind of, whenever I see this, I just kind of want to try to mention it as much as I can. So look, right now, this chart is based on if you did it at 70 cents, you got an immediate execution at 70 cents. That's what this chart is based on. So if the stock sits here, so right now the stock is what? 110.61, right? You sold the 110 put, bought the 105 put. If the stock at expiration is anywhere above 110, you keep this entire, whatever you sold it for, that credit, you would keep it, because both options expire out of the money. They both are worthless. They just go away. You keep that credit. If the stock goes up, that's good for you. You keep the credit. If the stock goes down, it breaks through your strike. You start losing money here. If it goes below the 105 strike, you have to buy that spread back for $5 at expiration. If you sell it for 70 cents, you buy back for $5, you lose $4.30. Okay, so that's what this looks like at expiration. If you sell it for more than 70 cents, this whole thing shifts up, right? This graph is based on you selling 70 cents. If you sell it for $2.10, the profit, this green part will shift up by $2, up to $2.10, and this part over here will shift up, and your losses will be reduced because you sold it for a higher amount. All right, so that's how to looking at this chart. So let's take a look from a theoretical price now. Okay, you know what? Before we do that, let's just take a look at a couple other statistics here. And of course, we don't know where Yum Brands is going to be, on May 7th. There's no way of knowing where the stock, what's going to happen until it happens. I don't know what's going to happen tomorrow. I don't know what's going to happen a year from now or 10 years from now. Until it happens, nobody knows, just like I don't know who's going to win the Super Bowl until the game is played, right? But just like a Super Bowl or a football game, we could kind of take a look at, well, which team do we think is better? Which team is more likely to win just based on, their historical statistics. So let's just see, what did Yum Brands, statistically tend to do, the stocks. So we know that this expires May 7th, these options. It's April 6th, let's say April 5th close, May 7th. So historically, between this calendar period, April 5th to May 7th, Yum Brands, what did it tend to do? So we see here on a seasonality basis, 75% of the time during that period, historically in the last 10 years, or up to 10 years if there's enough data, 75% of the time, Yum Brands was higher. From April 5th to May 7th, Yum Brands went up. 25% it went down. The average, on average, it gained 6.6%. So this is our first stat. So we see here, if we divided it up, on average, if we took all the up moves, you see I'm hovering over it. On average, all the up moves was up 9.3%. If we took the average of all the down moves, 1.5%. The best return was 33.6, worst return 3.4 in that calendar period. So this just kind of gives us a little bit of a distribution, return distribution around a calendar period. Sometimes, stocks may tend to be weaker during certain times of the year. Maybe sometimes stocks tend to do better during certain times of year. And anything could happen, right? So between now and May, any kind of news could hit and make that stock reverse. We're just looking at it from a statistical point of view. Stock drift. Well, we know that there's going to be 24 business days between now and expiration, 24 days of volatility, 24 trading days. So what does Yum Brands tend to do over a 24-day period, right? Because you got a lot of stuff going on during the 24-day period that will just naturally push the stock. Like if they're pension funds putting money in, or ETFs or whatever, if they're pushing money in there at some kind of constant rate, what does it tend to do? So we see that over a 24-day period, 68% of the time Yum Brands is higher. 32% of the time it's lower. On average, it gains 1.7% over a 24-day period. We see an average up move 5.2%, average down move 5.8%. Best move it had in a 24-day period, up 24%, worst move 36.8%. Again, quickly, we're just getting stats on a return distribution. This is how the stock tended to behave. Okay, so here, at least from this perspective, those look like positive numbers, and it's technically right now in an uptrend. So having said that, let's come back down to this spread. So this spread is a bullish spread, you could see here. So it kind of is in line with this if you want to take this out. Now, also, you want to go read any news or any type of events coming up that could change this, right? Anything could change those based on any type of new events. But at least if we have this outlook, then this bullish spread kind of is in line with that outlook. Is everybody okay with that?
Yeah.
So what do we think this spread theoretically is worth, right? Based on historical stock behavior, is this 70 cents? Is that a fair deal? Is it too low? Is it too high? Right? Let's take a look at that. So I'm going to go look here at the theoretical value using historical distributions. So what this is doing is looking at the last 4 years, and it's saying, based on the returns of Yum over 24-day trading period, and we're going to look for similar situations where we're going to set the implied volatility. You could change this. This is dynamic right now, based on the implied volatility levels similar to today's. Okay, so right now we see that it's more in the subdued. It's gonna look for those types of periods. It's also gonna look for periods that cover an earnings event, because here we see we chose May 7th. Earnings are expected to be released April 28th. So if we hold it to expiration, it's going to cover an earnings event, right? So during earnings, stock can move differently than when there are no earnings, because then it's a binary event. So it's looking for this type of situation, right? It's trying to look at historical data to match up similar situations and saying that in the last 4 years, we found 18 observations, and we could expand that, or we could change these assumptions. But using in the last 4 years, similar situations, if you did this similar spread, basically same amount of time to expiration, same distance of the strikes away from the stock price, you did this spread over and over again, on average, the end value would be 75 cents. Okay, so if you're selling it at 70 cents, it's close, 5 cents lower than the average. But 83.3% of the time, if you sold it at 70 cents, what this is saying is that you would have been able to buy this spread back for less, resulting in a profit. So obviously, if you could get it for 210, that might be a pretty good deal, right? Anywhere near $2.10, according to this, that'll be a pretty good deal. Let me look at, let's, instead of narrowing down the implied volatility range, what if we use all the results, no matter where the implied volatility was? I'm going to say rerun this and use all the implied volatility historical. So I'm going to rerun this so you could see this jump to 41 observations, right, from 18. This is using all the implied volatility levels. Doesn't matter if it was subdued, elevated, moderate. We're using all of those. So now we got 41 observations. Theoretically, this changed. Now it's 80 cents. So if we did this, so in other words, if you did this spread, similar situation as far as days to expiration, strikes same distance away from the spot price. At expiration, on average, it would be worth 80 cents. That's the average value, sometimes higher, sometimes lower. Average value 80 cents. 75.6% of the time, if you did it at 70 cents at expiration, you would have been able to buy back cheaper, resulting in a profit. All right, so that's changing that. What if we just did it in a more recent history? We could change that to 2 years of data. I'm going to reload that. So in the last 2 years, you could see it's been more volatile. So if I use 2 years of data, narrowed it down to 21 observations, obviously that's going to cover that coronavirus event. Now we see that's about, on average, we're closed at $1.04. So that's where maybe, getting closer to that 210 is more important, which was the midpoint. Remember, 210 is the midpoint of this market, and 71.4% win rate in the last 2 years. So again, you're just looking, you could change this data, to rerun it, and just test it out that way. Again, this is only giving you theoretical value based on historical stock behavior. Is that everybody okay with that so far?
Everyone seems okay with it. Any questions with that piece of this discussion? Let us know. It's a little bit of a delay, so the questions may come in 30 seconds or something. So I'll keep you posted.
Okay. Another thing we could look at is, well, here we're looking at 2 different strikes, right? So we got 24 business days to go, trading days to go. We got 2 different strikes. So one strike, the 110 strike, is a little bit over 0.5% away from the spot price. Then we got another strike that's 5% away from the stock price. And the implied volatility on these strikes are different, right? So one is 20.3 to, well, this one's very wide, right? So these are very wide markets. But you could see that if we let's just use the bid, the bid to compare the bid to the bid. So on the 110 strike, the bid is 20.3 implied volatility. So that's taking this stock, this option price, converting it, putting it into the Black-Scholes model, in our case, binomial model. We're converting it to an implied volatility. So it's 20.3. The 105 strike is 22.7. So there is a skew, right? So there's a skew between these two implied volatilities. So the question is, how do these implied volatilities compare to historical levels? So here we could do that using the IV Theo. So this one will just based on, okay, you know what, so we don't have enough data for this one. So I can't do it on this IV Theo. Probably because the markets are very wide as well. These markets are very wide. So let's take a look at it from a different perspective, Yum. Let's take a look at it from fair value. So here we'll take a look, is Yum, you know, overvalued, like how does it look historically from a fundamental perspective? So we see here right now, Yum is 110.64. We think the implied value or theoretical value of Yum based on historical multiples is 103.35. So that's a 7% premium, but that could be, you know, in line. That's not too far away. And it could be justified. So we could just take a look here how we got there. So what we'll do is say, if we use the 3-year PE ratio, so basically if we took Yum's market cap divided by its trailing 12 months earnings, and we said what multiple does it on average trade above its trailing 12 months earnings, that's 24.3. So if we use that as our benchmark, this would be the implied value. We could do the same thing, price to sales. So if we took its market cap divided by its total trailing 12 months revenue, what multiple does that tend on average trade? That's 5.5. If we use that as our benchmark, this is the implied value. We could do the same thing, price to book, operating income. So then we'll take it a little bit further and say, well, how does the P ratio compare to the rest of the market? So right now we see Yum's P ratio is 37.6, SPY, S&P 500, 39.6. So it's trading at a 5% discount to the S&P 500. Historically, on average, it's traded at an 8% discount. So if we use that as our benchmark, this is the implied value. And we'll do the same thing with price to sales and price to operating income. So if we took the average of all these, we get this implied value. So you could see it's kind of close. You know, it's not ridiculously overpriced or underpriced. It's kind of in line there. So it just depends on your outlook for that next earnings. We could also take a look at it using forward-looking estimates. So here we didn't generate anything yet, but let's take a look why. So what this will do is take a look at Yum and say, how does Yum fundamentals, if we use forward-looking estimates, basically, you know, we looked at historical multiples, but what if we used, you know, gave it some growth, right? Like we said, well, it's going to grow its revenues and its earnings at a certain rate. How does that compare to the rest of the market? Is it overpriced, underpriced versus the rest of the market? So let's take a look here. We're going to compare it to the benchmark S&P 500. So operating margins. You could put any of your estimates in here for Yum and S&P 500. But we're going to look at operating margins, revenue growth, and the volatility for risk as part of this model. So we'll start out, you know, defaulting to using its, you know, historicals, right? So the first assumption is, well, if we used its historical operating margins and growth rates and assume that will continue next 5 years on average, how does Yum look versus S&P 500? So Operating margins in Yum, 29%, the current ones, versus S&P 500, 11.5%. So you can see Yum operating margins are better. And that's operating margins those are profits that are coming from its core business, right? So it's just looking at its core business and looking at what are its profit margins from its core business. It will exclude any profits or losses from other investments that are not part of its core business, like investments in other stocks, bonds, or whatever. So Yum, 29% versus S&P 500, 11.5%. Revenue growth. So we see that S&P 500 in the last 3 years on average grew 4.4% in revenue. Yum in the last 3 years declined on average 1.3%. So that's why we're not generating anything. But let's just say I'm going to give it 1% growth. So we'll just say for the next 5 years on average, revenues will grow 1%, which I think it's okay. It's modest. Okay. And this is the volatility of Yum, 28.2 versus SPY, 19.7. So I'm going to calculate this. And here, the implied value of Yum, it's not risk adjusted for, right now, it's not risk adjusted for volatility. But if we, excluding the volatility portion of it right now, based on this, the implied value of Yum is 131.56 versus market price 110.64. That's a 15% discount. So how do we get there? Let's take a look. So here's the calculation results. S&P 500, Yum. If S&P 500, we bought all the stocks, that'll cost us $37.4 trillion. Last year's revenue in S&P 500, 12.2 trillion. Yum, we bought all the stock, that's market cap 33.2 billion. Last year revenue, trailing 12 months, 5.7 billion. So if we looked in the next 5 years and said we gave S&P 500 revenue growth 4.4% per year, next year revenue will grow to 12.7%, the following 13.3, 13.9, and so on. If we assume that the operating profits will be 11.5%, so that would be the profits from this revenue for each year. All right, so cumulative, if we added up 5 years of profits, it's 8 trillion. So if we took $8 trillion in profits in 5 years and we paid 37.4 trillion to buy all the company, all the stock, that's a 21.4% return on invested capital. Okay, in Yum, let's do the same thing. So we're going to assume 1% growth in revenue per year. So you can see there's modest growth every year in the revenue. And if we took 29% of that as profit, this is the profit per year. So if we accumulated 5 years of profits, it's 8.4 billion, market cap 33.2. So the return on invested capital, 25.4. So here it is, Yum, 25.4% return, 21.4% in S&P 500. So what would Yum have to be priced at to equal the return in S&P 500, assuming that they both had the same risk? That would be 131.56. Okay, is everybody okay with that?
Yeah.
If we adjusted it for the risk, so we could see here volatility in S&P 500 is lower than Yum. So in other words, if they both go down, Yum will has more risk. It'll go down by more, right? So if we accounted for that, I'm just going to switch to that. So you can see if you accounted for risk, 91.9, that would be 20% premium. So it depends how you want to look at it. So we looked at a couple things with Yum, right? We looked at the spread, the theoretical value of the spread. We looked at a statistical analysis, how the stock tended to behave. We looked at the return distribution, how the stock tended to behave based on seasonality, based on the days, the holding days to expiration. We looked at the theoretical value of the spread, the risk reward based on the chart. We also looked at the fundamental analysis in Yum based on fair value. And now we're at 9:30. So
Quick, Abhishek asks something real quick. He asks if there's a stock screener which can list the stocks whose fair value is less than the S&P market value. I don't think we have anything like that, but I know people have asked for it in the past.
Yeah, we don't have that yet because these are relatively new tools. So as I'm going through it, I'm going to add some more factors into it. Like any model, you could add, more fact. So it's not fully yet developed. So we didn't create the screener as of now. But these are the starting points, right? So these are the starting points right now. You'd want to still look at, you could look over here because if it's let's say it's trading at a premium, it could be for a reason. So you want to still check the news and look at it. Like when the stock popped, did they announce something that could be very justified, right? They could have announced a new product. They could have given guidance. They could have announced a new strategic alliance that wasn't there before. And you want to go through that and find out, because even though you got this 7% above a historical multiple, it could be very justified. It could be even undervalued based on what's going on in that company. Okay, so we're just looking at benchmarks, but you still need to do further research.
Awesome job, Dima. Way to take it to the next level. One question, and it was a webinar on Yum Brands credit put spread. Very cool, buddy. Thanks.
Cool. Well, thanks everyone for joining. Stay safe. Have a good trading day. Hope to see you guys tomorrow.
Mayor Mike, thanks for the question. Camille.